Hey guys, Adam Hebener up here at Modern Mortgage, and this is a continued video in the series of educating our clients on the best ways to learn about and then consume mortgage products. We want you to be informed clients so that you can make good decisions and feel empowered whether you work with Modern Mortgage or any other bank that's out there. Although certainly it's our goal to earn your trust and take good care of you. The next video in this series is really going to be on the topic of what do we look at when we try to qualify people for a mortgage. And when I say we, I don't mean Modern Mortgage in specific, I mean the whole mortgage world. And so what I'm going to try to do is give you 4 topics that you can be thinking about a little bit, apply to yourself, and kind of wonder how you'll do. If you already have a mortgage and it didn't go as well as you wanted, I bet one of the problems came up in one of the 4 I'm going to share with you here. So the best way to remember it is we like to use the 4 C's. The 4 C's will help you understand exactly what it is that an underwriter looks at, or any kind of financial institution that lends money. These 4 C's help us determine whether or not we're making a loan that's high risk or low risk, or sometimes that will determine your interest rate. How high it is based, the higher risk you represent, the higher your rate will be. And in fact, sometimes when you can't get a loan, it'll be because your risk is too high. So here's the 4 C's. The first one is cash. Cash means how much money do you have at hand? How much have you saved up? Or how much of a gift are you getting? Do you have an asset you can sell that's going to bring cash to you? Are you receiving some money as a result of an inheritance or some other kind of windfall? You won the lottery maybe, which would be nice. How do you have the money in your account? That's the first thing we're going to look at. There's all kinds of things we have to consider when it comes to that, but typically down payments are very, very low. They can be as low as $1,000. The better loans tend to start with down payments of 3 to 3.5%, and then we usually want you to have a little bit left over. We call that reserves for obvious reasons. We want to have that money laying around after you close on the home, so that we know you still have a little bit left over to maybe buy a couch and make your payment if your job goes south. We want to make sure you still have a quality of life. And so we're looking at that when we look at cash. The second of the 4 C's is what we call capacity. Capacity is actually just a proxy. It makes it fit for the nice 4 alliterations, the 4 C's I'm going to give you. But capacity refers to how much income you earn. And the amount of income you earn minus the amount of debt you pay is what we call your debt to income ratio. So what we'll do is we'll add up all of the debts that show up on your credit report. So maybe your car payment, your credit card bills, your student loan bills. These are the kinds of things we're going to add all of them up. And then we're going to take that number and divide it into your pre-tax income. So your gross income. When we do that, it gives us a percentage number, a ratio. And that number is the number we're going to use to determine your capacity to repay. Now, typically in most loans, we want to see that number somewhere in the high 30s to maybe the high 40s, depending on the kind of loan you're doing. And if that's in the high 30s to high 40s, you're probably going to get approved for your loan. If it's much lower than that, it's going to be easier to get approved. If you're much higher than that, say 60%, we add up all your debts, divide in your income, and you're at 60% or higher, you're very likely not going to be able to get a loan, and that's a place you're going to want to focus. Get rid of some of that debt, get out of the student loans, sell the car, get a cheaper car. Always a better idea when it comes to comparing, having a great car or having a great house. So that's the second of the C's. The next C is what we call the collateral. And collateral refers to what is standing, think of that word, collateral, what's standing right next to you in guaranteeing that the loan is safe. Well, the thing that stands next to you and guarantees that the loan is likely to be repaid is the value of the home. That's the collateral. So we make the loan against the collateral. The way we check the collateral is doesn't usually involve you as a buyer. We check the collateral by doing an appraisal. And that's where we ask a third-party expert to come in. They're not involved in the transaction. They don't know you, and they actually don't know us, which surprises lots of folks. And we say, hey, would you please take a look at this home and tell us how much it's worth, so that we as the bank and you as the buyer both know we're paying the right market price. Now, when we look at that appraisal and subtract out from it your down payment, which we covered a moment ago, you can see that lowers risk quite a bit, because if we find you can't pay us back, hopefully the home itself will pay us back if ever you need to sell it. That's why that becomes the third C. The fourth and final C is one we'll do a whole series on itself, but it is your credit. And credit is super, super important. There's lots of questions and concerns about credit. I'm going to give you a very quick summary here. First thing to know when it comes to credit is that we do not care what any of the consumer credit sources have told you your credit score is. So if it's Credit Karma or you Googled credit online and you got some kind of local cutesy credit company, we actually will not use that in the industry, the mortgage lending industry. The entire industry will only use one source for credit, and that is called a FICO score. FICO stands for Fair Isaac Corporation, and their algorithm is the best algorithm. It's considered the industry standard, and it is how we determine what your credit score is. Now, you may know there are 3 bureaus: TransUnion, Experian, and Equifax. Those 3 bureaus hold all of your credit history. What FICO does is climb through those bureaus and tell us exactly what your credit history is. And from each one of those sources or bureaus, they'll give us a credit score. We'll take the middle of those 3 credit scores, and that will be your score. Now, what's the lowest score? What's the highest score? That's something you need to talk to one of our lenders or one of our certified mortgage loan originators about. But just know, generally speaking, from the high 500s on up is going to be an area where you can get a good loan. If you don't know what your credit is, you do need to talk to a company like ours or some other mortgage company who can actually pull that FICO score for you, because Credit Karma and the other kinds of iterations are not going to be able to tell you what that information is. So make sure you call us, reach out to us. We'll help you walk through that. Hopefully this is helpful to you. Those are the 4 C's. That's how an underwriter thinks when they look at your file. And when you've got questions, give us a call. We'll help you kind of figure out what fits your specific situation. Now, this has been a little bit longer video because it deals with a pretty deep subject, but there's going to be more videos coming. We're going to tell you a lot more about the mortgage process and industry. And if you have questions, thoughts, other videos you'd like to see, we'd love emails. So send that to us, and we'll keep making sure we're doing all we can to serve our clients. Thanks for the time. We'll talk to you soon.